Hello, and welcome to Redstone Wealth Management's weekly market commentary. Today we're going to be discussing and assessing the impact of geopolitical risk on the stock market. Recently, the United States airstrike on January 3rd of 2020 near Baghdad, Iraq, killed a top Iranian general, and it was a major escalation in Mideast tensions. Iran's retaliatory strike on January 8th sent a message, and additional responses can't be ruled out. We discuss what this conflict means for stocks and ongoing risks. Now, we have to focus on how stocks and geopolitics come together. The latest developments in the Middle East understandably have many investors on edge. As market strategists, we face the difficult task of separating the human toll and the economic and financial tolls. This is never easy when lives are lost in times of geopolitical conflict. For investors, the good news is that stock market has a long history of shrugging off significant and unsettling geopolitical events. As serious as this escalation is, previous experiences have shown us that these developments may not have much impact on U.S. economic fundamentals or corporate profits. That means any resulting stock market volatility may be fleeting, as was the case last week. On average, the stocks fully recovered losses within 47 calendar days, less than 7 weeks after an average loss of 5%. The market's track record of recovering quickly from these events can be reassuring. Accordingly, we want to be careful and not overstate the potential impact of geopolitical events, no matter how unsettling they might be. But we have to ask the question, where do we go from here? The S&P 500 index has jumped more than 10% since the start of the fourth quarter of 2019, which means investors priced in a lot of good news late last year. A U.S.-China trade deal, stabilizing global growth, the pause in the Federal Reserve rate hikes are at the top of that list. As a result, we think some potential 2020 gains were probably pulled forward into late 2019, perhaps limiting the upside for 2020. Regardless of how the Iran conflict plays out, we may see stocks get repriced over the next several months as investors wait for the economy and corporations to deliver against those loftier expectations that are accompanying the current higher stock prices. To be clear, we're not calling for an immediate stock market correction. In fact, we still think that stocks will move higher between now and the end of the year. Higher earnings could potentially push stocks higher. In the meantime, we wait for the fundamental improvement that has been priced in. That could also be accompanied with increased volatility. We know that bull markets historically have tended to include several pullbacks of 5 or 10% in any given year. We should be braced for that. Hopefully, the stock market repricing will come more from growing corporate earnings rather than falling stock prices, though. There are still several geopolitical and economic risks in the stock market to monitor besides what's going on in the Middle East. Geopolitically, Phase 2 negotiations with China that were just signed today are looking hopeful, but as always could break down, causing further volatility. North Korea remains a threat. Economic risks include a potential pickup in inflation that could trigger renewed fears of the Fed rate hikes, as well as the possibility for deteriorating growth in Europe and Japan. Finally, domestic politics carry the potential disruption for markets, including possible fallout from the impeachment process and policy uncertainty ahead of what will most likely be a very highly charged U.S. election. All that to say, we still want to focus on the fundamentals. While heightened geopolitical uncertainty can be unsettling for investors, we will continue to focus on the fundamentals supporting gross domestic product, inflation, employment, interest rates, and corporate profits when making investment decisions. Our focus on the fundamentals served us well last year, and we believe that it will do it again in 2020. So we thank you very much for joining us on our weekly market update. We look forward to seeing you again next week.